Prepare yourself for an exciting journey as we explore the mind of George Soros, one of Tesla's largest and most contentious investors. While investors have been frantic due to recent price variations in Tesla stock, Soros has been taking advantage of the decline and tripling his stakes in the massive electric vehicle company. While many have sold their shares out of panic, it's time to see why Soros has been going less traveled while loading up on Tesla stock. Come along as we examine the thinking behind Soros fund management in greater detail. The decision is yours, but first hit the like and subscribe buttons. In light of the recent fluctuations in the price of Tesla stock, you may be debating whether to cash out your holdings to the highest bidder or whether, like George Soros, you should keep buying shares in the hopes that the stock will continue to rise dramatically through 2023. Anyway, good to have you back in the game. In spite of this, a recent regulatory filing reveals that renowned investor George Soros took advantage of Tesla's decline this past year and loaded up on shares of the electric vehicle maker, tripling his stake in the company in the last few months. This is in contrast to many other investors who have sold and are still selling their shares out of fear of losing out. Tesla stock has been volatile for a long time, leaving investors with many questions amid a 50-point drop in the market. Based on Bloomberg's Billionaires Index, the net worth of Tesla investors is $8.5 billion, up $1 billion for November 22nd. George Soros founded Soros Fund Management, a family office that oversees over $28 billion in assets across a wide range of asset classes and investment strategies, including public stocks, fixed income, commodities, foreign exchange, alternative assets, and private equity. Soros is well known for his charitable work, with the majority of his company's wealth going to a charity called Open Society Foundations, which supports activists worldwide. According to an SEC filing, George Soros' investment business bought a sizable number of Tesla bots in the first quarter of 2018. Soros disclosed his Tesla stake in the second quarter, indicating that he first acquired Tesla shares between April 1st and June 30th. At that time, the Tesla investor held 2,983 shares worth $20.1 million in its largest common stock initiation that was not a merger target or an option position. A group of investors called the Soros Fund Management Group invested $35 million in convertible notes bonds with the potential to convert into a specific number of common shares, establishing the company as a significant supporter of the automobile. It was surprising to find that the family office has been a longtime shareholder in Tesla common shares, with that stake increasing significantly in recent years. As of March 31st, 2022, there were only 2,000 listed as held. However, as of June 30th, 2022, there were 355,250 shares disclosed per a regulatory filing. Soros has tripled his investment in 3 months, owning 89,647 Tesla shares with a market value of $16.4 million. Even though Tesla CEO Elon Musk has been reportedly obsessed with Twitter lately, this will also change. The price of Tesla shares has fallen this year and has since rebounded, but there have been concerns that the manufacturer is facing a decline in demand across various markets. Despite this, the company has always been thriving, according to a recent note from longtime Tesla bear Citigroup. The electric car manufacturer will likely be eligible for a tax credit in 2023, which will allow it to overtake its competitors in the market. Despite this, the Biden administration's Inflation Reduction Act will likely give rise to micro-competition concerns, which will likely persist as capacity increases in a hard landing scenario, as stated by Italian Mugili. This tax credit will help lower inflation and strengthen Tesla's long-term competitive position, according to recent rumors. In an attempt to boost output at its U.S. site, Tesla is moving engineers and production staff from its California plant to Vermont to start automating the production of its EVs. This will enable the company to produce cars at a lower cost and generate demand in the future. Recently, the company installed state-of-the-art machinery at its Fremont, California plant because of the high level of automation of its production lines. By replicating the same edits from one facility, Tesla was able to significantly increase production. The Shanghai factory upgrade is credited with helping Tesla deliver a record 135 cars in China in September. The process involved machinery maintenance and several other improvements, and it took about 5 weeks. The manufacturer of EVs has already forecast that over the coming years, output will rise by 50% on average. One factor that might outpace Tesla's demand is the large number of EVs. EVs are steadily upending the gasoline industry, and as gas prices climb, more drivers might look for less expensive options. When comparing Tesla's profits to those of other electric vehicle manufacturers, it is evident that Tesla comes out on top. According to a recent report, Tesla made 8 times as much profit per vehicle as Toyota Motors did in the July-September quarter, despite being outsold more than 7-1. The Toyota Group sold 2.62 million cars during the quarter, which is 7.6 times as many as Tesla's 344,000 cars, but its net profit per vehicle was significantly lower than Tesla's. This was the first time since Tesla went public in 2010 that the company's quarterly net profit exceeded Toyota's. As with any manufacturing company, Tesla will experience significant periodic fluctuations in its profit margin as it attempts to keep up with the traffic expansion, exhaust gas turbochargers, global production, and Tesla may have steadily stabilized and shifted their attention to key performance indicators KPIs such as free cash flow and earnings per vehicle sold. Even though Tesla has been having difficulties lately, investors are generally optimistic about the company and its analysts who have been following the electric car market. The most recent conversation between George Soros and Tesla may help to elevate the company's profile in the eyes of investors. In a recent interview, American investor and fund manager Ron Barron forecasted that Tesla shares will be priced between $500 and $600 by 2025, and that the company would be worth $4.5 trillion by 2030. The market generally seems to agree with his predictions. The stock analyst had connected his assessment target to Tesla's annual car production. He was most concerned with the company's ability to grow rapidly over the next 10 years and eventually begin selling about 20 million cars annually. As noted by Adam Jonas, Tesla investors face risks related to Elon Musk's Twitter activities, but the company is still on pace to grow sales by about 37% next year, in addition to piquing investor curiosity. We believe Tesla is in the strongest position among original equipment manufacturers to receive consumer tax and product action credits. With respect to the IRA, we believe Tesla's competitive advantage could potentially widen. The investors in Tesla are managed by Soros Fund Management, a family office that handles both public and private equity. The stock market requires managers of funds with more than $100 million in U.S. equities to follow a document known as the 13F within 45 days of the end of each quarter to list their holdings and securities trend changes. The U.S. equity portfolio has recently increased by 4.3% quarter over quarter to almost $5 billion. Now that Tesla is included in Soros Management Fund's 13F filings, more investors will be able to provide input based on Tesla's fundamentals rather than on price fluctuations here and there. What do you think? Let us know in the comments below. I'll see you in the following video.